Hyperion was founded in 1996 as a growth equities manager, really doing growth equities in a concentrated, quality, structural growth manner. And Hyperion's been doing that successfully for nearly 30 years. And we founded the global equities product in 2014, so have an over 10-year track record of adding value in global listed equities as well. But what Hyperion's incredibly proud of is the ability to compound capital at high rates and make a difference for clients. We have accepted 1.5 billion in net inflows from clients and today manage 15 billion of capital. So effectively for every $1 clients invest with us, we've been able to grow that into $9.80. So we think that's incredibly rare and valuable. And how we've managed to do that within the broader growth universe is by being really targeted. So we don't want to go too early, invest in growth companies that may be speculative, concept in nature, momentum driven. We think these growth strategies are value destructive. We also don't want to be too late. We don't want to invest in maturing, established businesses where the returns are low. And Hyperion's had a track record of producing nearly 20% per annum returns through finding that inflection point in global equities, where we're looking for these businesses with strong value propositions, incredibly sustainable competitive advantages, and they might be doing something modern, innovative, even creating new industries, and where the profits and earnings in the future are substantially larger than today, and they're misunderstood by the broader market. So whether it's Spotify pioneering streaming in audio, whether it's ServiceNow digitizing your workflows in your office, or whether it's Amazon pioneering e-commerce or AWS in terms of the cloud, these can add value, and this includes Tesla, which has pioneered electric vehicles and is now leading the world towards autonomy in both vehicles and humanoid robots. When we think about the broader macro environment, we're really careful not to get caught up in short-term noise, which we don't think has any inherent value. So short-term share price moves, recent news flow, short-term macro data points, that's all noise rather than signal. And so we're really a bottom-up, fundamental stock picking organization. But it's worth actually commenting on Trump and potentially his tariffs. Clearly, in the early stages, particularly in the first 100 days of a presidential cycle, arguably there's the greatest uncertainty. And when we look at the volatility that President Trump's created, we believe he can easily undo that, just as he's created that, either by reversing some of the policies or negotiation. So we encourage investors to look forward, and we believe there will be a period of stabilization. And Trump is pro-business, pro-growth, and pro-equities. So ultimately, he wants to decrease taxes. He wants to encourage businesses. He wants to reduce fraud and bureaucracy. So as we go through presidential Trump's term, we believe he'll be broadly supportive for equity markets. When we look where inflation's been over the last 5 years, it's trending back to closer to historical norms or lows. So again, it's a good reminder to not fall foul of a cognitive bias around a recency bias. So when inflation spiked at 9 or 10% in the US in 2022, there was real concern that will continue into perpetuity. And clearly that was unfounded. Of course, tariffs can have a short-term impact on inflation, but we believe that would be a one-off, and then there'll be a period of stabilization. And in fact, longer-term inflation should trend down. Artificial intelligence and machine learning is incredibly deflationary because it creates abundance at low cost. If we move over into interest rates and the framework there, 10-year US Treasuries have been range bound between 4% and 4.5% over the last few years. And so we think we're in a incredibly supportive position if there is any economic contraction or even a recession in the US or globally. And so the markets are in a much better position now at a 4.5% interest rate than at 0.5% interest rate. And clearly, the ability to cut interest rates quickly and dramatically is supportive to valuations of assets and means price to earnings ratios can expand and actually offset and be a natural stabilizer to any earnings revisions in a negative manner. But when we look at Hyperion's portfolios, they're incredibly low sensitivity to broader external factors. And the reason is a lot of the growth is internally driven. So it's by your strong product pipeline, your ability to take market share, particularly against weaker competitors in poor economic environments. So we're encouraged with the economic backdrop that we have, and Hyperion's portfolios should have less sensitivity to any economic contraction and more support from any interest rate cuts from high levels to low levels. When we look at the portfolio today for the global fund, we currently have 22 stocks, and we believe the fundamental risk in these businesses and portfolio is incredibly low. So that's different to volatility, beta, tracking error. But if you look at the underlying fundamentals in these businesses and these industries, they are incredibly robust. And we believe the portfolio's earnings will be substantially higher in 10 years' time than today. So when you look through this portfolio, we actually believe it's a hedge against any disruption. It's pro the future, pro innovation, and tailwinds such as artificial intelligence and machine learning are incredibly supportive to this portfolio of 22 names. And just to note, with any drawdown, we try and allocate our capital to our best ideas, our new ideas. And we've added NVIDIA to the portfolio, we've added Axon to the portfolio, and we've removed some of the lower weights where we've had lower conviction, such as Airbnb, Roku, and Caring. So again, continually looking to increase the quality, growth, and returns of the portfolio. When we look at the track record since May 2014 for global equities, the returns have been driven by earnings per share growth of 22% per annum over that 10 or 11 year period. That's incredibly high rates, and what it's done is created permanent value capture. So that's different to price to earnings ratios moving to capital speculation. The creation of these earnings is permanent and real. And that gives us a lot of confidence to continue to forecast into the future. And this current portfolio, we believe, will deliver 23% per annum earnings per share growth. So hopefully the future looks very similar to the past. When we roll to the next slide, you can see the supporting evidence over this framework in global equities. 21.4% of the 22.4% returns have been driven by earnings per share growth. So again, PE expansion, dividend returns are only a low component of the fundamental returns that we've achieved. As we look forward, we forecast out our returns. We have a 10-year internal rate of return or a 10-year IRR. And in pink, we can see historically what those forecasts have looked like. And to the right, we can see that the forecast 10-year IRR is comfortably in the low 20% per annum, which means future returns could arguably be higher than historical returns, and the margin of safety is therefore higher as well. To give some confidence in forecasting, you need a track record of success, and we believe Hyperion are one of an elite small number of managers that have produced excess returns over long periods of time against our benchmarks and across multiple products. So whether we look at our global equities fund, which after fees has produced excess returns of 5% per annum, our Australian equities fund at broadly 2.5% per annum, which is a great outcome at the scale that we operate at, or our small cap fund, which has produced an exceptional return of over 8% per annum versus the benchmark. And although the small cap benchmark is relatively ordinary. So again, that historical return provides some foundation and confidence that with the same process, team, and inefficiencies, we can produce similar returns as we look forward. When we think about allocating capital to markets, particularly in periods of volatility like we've had over the last 5 years, we really go back to first principles, and we believe that as long as you believe capitalism will continue to drive markets, institutions will continue to operate adequately, you have a wealth creation machine where earnings should continue to drive higher, markets and portfolios should be able to drive higher. So when you get a technical sell-off, you get rare opportunities to allocate capital with a higher margin of safety. And in effect, you're taking an asymmetrical bet where as long as the system remains robust, the market should recover and move higher. So in effect, whether you're an equity investor or specifically a growth equities investor, you need to be a believer in a better tomorrow.